Hello and welcome to InvestorToday.ca. I'm your host, Dave Glover. InvestorToday.ca is brought to you in conjunction with RBL Communications, your online IR professionals. We're coming to you live from the New York Hard Asset Show. It's May 14th, and I'm standing here with David Urban. David Urban, who is a true contrarian. David has many years in the financial services sector, and he has an incredible instinct and an incredible understanding of the markets and how they're playing out, not just right now, but how they're playing out probably in the future, huh, David?
Yes, thank you.
Nice to see you again.
Thanks for having me, Dave.
Welcome back.
Pleasure. Yes.
Well, we haven't had an opportunity to actually stand face-to-face. A number of the listeners will remember David Urban, who is a regular contributor to InvestorToday.ca. So thanks a lot for that. And at the end, we're going to give you a chance to plug your website, David, okay?
Thank you.
So let's talk about what's going on right now. I mean, today has been just a crazy day on the street. I understand the markets were down considerably. I believe the Dow is only off about 60 points right now.
That's true. I mean, the market's come back a little bit, but what we're really seeing play out is a little-known technical pattern called three peaks in a domed house, which sets up over a 2 to 3 year time span and is comprised of approximately 27 different data points. So it's very long-term, very technical. However, we're right at the end where the market is going to begin to fall, and I'm expecting a pullback to at least the 200-day moving average within the next month.
So a lot of people have been asking this, not only of themselves, but of their investor analysts and their broker. How long is this going to continue?
Well, I think we're definitely going to see a pullback until the middle of June, at least to the 200-day moving average. At that point, we're going to have to reassess where we are with all of the problems that are going on in Europe and in Asia. We've got conflicting signals coming out of China, considering whether or not they're in a recession. We've got the problems with Greece. We've got the problems with Spain. We've got problems in Portugal. And we've got problems in Italy. So there's a number of problems that can send the market lower. But I think in the near term, we first need to move back to the 200-day moving average, get the averages on a firm footing, and everybody just kind of, once we're there, reassess where we stand, globally, problems in Greece and Europe and in Asia.
Well, it begs the question, are we going to see the end of the Eurozone? Do you think the Euro is going to go the way of the dodo, or do you think they're going to be able to find a way of fixing the situation?
I think that in the end they'll find a way of fixing it because the primary core countries, Germany and France, have a vested interest in staying in the euro, and they want to stay in the euro. What they're angry about are countries like Greece that don't want to go through austerity, and the Germans are looking at it as when we integrated East Germany into West Germany, it took us literally almost 10 years in order to successfully merge these two areas into the powerhouse that you have now.
Right.
And they're angry because they're saying, well, the Greeks don't want to have to go through what we went through in order to put ourselves on the firm footing we're on now. So I think in the end we'll survive, but I think we'll see Greece pull out. Spain will be given a bailout, and we're seeing that now with the bailout of the banking sector.
Right.
Italy, I'm not sure what's going to happen there, but I know GDP is supposed to come out this week, and estimates are it's going to be falling by 5%. There's structural changes in Portugal, but we're also seeing a pushback by the voters in these respective countries that are sick and tired of having to go through austerity programs without any sort of growth.
We've just seen an election in France that brought a socialist to power, and the first socialist since Francois Mitterrand, I understand. And you know that the main motivation for that was this austerity. And as you said, this is a pushback from the voters saying enough is enough. But is it enough? Have they done enough?
Well, I think people are they're tired of not seeing a growth compact alongside of the austerity plans.
Right.
I mean, we're seeing the austerity, they're going through the hardship, but what they're not seeing is any sort of programs that help boost employment. And velocity of money is falling. I mean, we had with the recent LTRO program that was started late last year and this year, we have the EU and the ECB lending money to the banks at 1%, and the banks are turning around, and instead of turning it into loans to small businesses and loans to help mid-sized businesses, what they're doing is they're buying up sovereign debt. So it's not helping the people that it was intended to help in the first place. And I think what the people are angry about is they feel as though they're being made to suffer without any sort of goodwill or good deeds for their suffering.
Well, and we saw that in the United States as well when the U.S. did that big bank bailouts, and there's looking at the possibility of yet another one with a major loss last week of a couple of $1 billion. And the taxpayer, the voter, is saying, well, where's my return? Where's my benefit as a taxpayer to do this? You know, as you said, you know, the old Reaganomics theory was, you know, if you throw money at it, that they'll put that money back out onto the street. It'll mean more jobs. It'll mean more growth. But it hasn't been the case. Not in this scenario.
Right. You're correct, Dave. You know, the money is not trickling down to the bottom line. It's not trickling down to Main Street.
Right.
It's being stuck at the bank level because they're just afraid to lend. The velocity has just slowed to a crawl. Money's not making it into small businesses. Money's not making it into Main Street USA. And this really is a problem.
Well, and that's where the jobs are going to be coming from. I mean, you know, let's not forget, viewers, the majority of jobs that are being created, even in this market right now, are being created by smaller, non-incorporated, mom-and-pop type organizations. They're the ones who are willing to invest their hard-earned dollars back into the economy because they know that that's going to present an immediate turnaround. But as you said, the larger corporations, what they're doing is they're taking the tax cuts, they're taking the corporate breaks, and they're putting that towards their bottom line, and that just means bigger bonuses for the guys at the top. But it doesn't mean more jobs.
That's true. You know, the money hasn't filtered down to Main Street USA, and that's what people are angry about. And they're angry that, you know, they're not seeing this growth compact. They're not seeing jobs created on Main Street. You know, they're hearing it in the news, they're hearing it in the paper, but when they wake up every morning and they go to work and they see their lives, it's not happening it's not happening on Main Street.
Well, and how many people have to ask themselves, am I better now than I was 10 years ago? I mean, the majority of people out there are saying, I'm making the same amount of money I was making 10 years ago, but inflation is about 18%. So, in fact, I'm not moving forward, but I'm moving backwards.
That's true. That's true. A lot of people feel that way. They feel as though inflation has just torn apart, you know, the disposable income that they've had. They look and they see a CPI of 2%, but what we're seeing in reality is gas prices now close to $4, up from $2, was it 4 years ago? And they say,
and the price per barrel is down to where it was about 4 years ago.
Exactly. You know, and we're seeing, and people are just looking at the prices they're paying for everything in the stores. They're seeing, you know, like a perfect example was local Dairy Queen by me last year. They didn't raise prices, but what they did was they cut sizes by 20 to 25%.
Right.
So now a large went from 16 ounces to 12 ounces, yet the price didn't change.
Right.
But we all know that on a per ounce basis, you're getting less ice cream.
That's right, exactly. Well, I noticed you're wearing your gold tie,
Yes.
and I know that you know you've always been kind of bullish on gold. Can we talk a little bit about gold? I mean, where it is right now, it's been fluctuating a little lower than it has been for quite some time. I think we dropped below $1,600 at one point last week. Are we still going to see a gold surge? Some people are predicting gold at $2,000.
Well, I think we'll see that later on this year. I think we're in for a little bit of weakness. This is the seasonally weak period for gold, the May through August months. But one thing to remember is gold has historically gone in spurts.
Right.
You will see a 6-month move up followed by a 12-month move sideways. And that 12-month move sideways will end in August of this year. So later on this year, I'm looking for some sort of catalyst. Something, I'm not sure what it is yet.
Maybe the U.S. election?
Could be, but I think it's going to be something close to when the Indian government came in and bought half of the IMF's gold.
Right.
And what we saw was the gold price shoot up by 10% in 1 week because it was a catalyst. Because all of a sudden this half this overhang that the market had been worrying about was removed. And I think we're going to see that again. We're going to see something is going to happen. And it is going to push the gold price higher. And I think next year we are going to see a gold price of $2,800, and I think we'll actually see $75 on silver.
Right.
As shocking as that may sound. But I think that we're, in the next few months, the summer weakness, we're going to see the prices pull back just a little bit more along with the market. And then I think later on this year we're going to see some sort of catalyst. and it's going to send gold and silver to new highs.
Well, I want to thank you for that. It's David Urban, the True Contrarian, and that website is?
www.atruecontrarian.com.
Always a pleasure to talk to you, David. I'm Dave Glover for Investor Today, brought to you in conjunction with RBL Communications, your online IR professionals. We'll see you next time.